Oh boy, it's time for jobs numbers. We've got jobs numbers coming up in the next 4.5 minutes. We have a market that is expecting 175,000 jobs, though I'll tell you the variety of jobs estimates that we have. In other words, the range and the dispersion of estimates is pretty darn wide. A lot of people all over the place with numbers on Wall Street. Usually we like to get numbers to be a little bit more consistent as an economy recovers. The more consistent economy is as numbers recover, the easier it is to actually estimate what people think. In terms of these estimates, we've got numbers ranging from 235,000 from Paragon Research. UBS is over at 210,000. Towards the bottom, we have SMBC Nikko thinking we're going to come in with 80,000 jobs. Regions Bank all the way down at 133,000. So, in other words, big wide range. So, there are 67 total estimates. The standard deviation here is about 24,000. Again, the low estimate is 80,000. The high estimate is 235,000. We're looking at an average of about 170 with a median estimate of 175. And so usually when we look for consensus, we're looking at that median estimate number. So 175 is that number, looking for an unemployment rate of 3.8, average hourly earnings of 0.3. That's going to be the market mover today. We've got oil up again, another percent today. We've got bond yields up 4 basis points on the 10-year, pushing us back over 4%, now sitting at about 4.03%. You've got gold still stuck at about 2050, as well as S&P, Dow, and NASDAQ futures negative. As yields have started to trend up, you've actually seen a little bit of hopium that the dollar might be the next best investment again. That's mostly because as interest rates move up for the U.S. economy, we tend to see an increase in the U.S. dollar relative to other currencies. So I know folks have been excited about that. We don't know if that'll end up working out, but we'll see. Maersk announced this morning that they are not just doing a 2-day pause or break for now. They are going to direct vessels away from the Red Sea, quote, for the foreseeable future, which is interesting because it just goes to show that, wow, did America really fail? Did we really fail at providing stability in the Red Sea? American warships failed? It's either American warships failed or there's some politicians who put too many restrictions on what they could actually do to do their job. Wow. I don't know. But pretty disappointing. I thought almost with certainty that America would not want to encourage any form of inflation going into 2024, a presidential election year. Oh well. You do have Jefferies, who downgraded Palantir. They suggest that the company's valuation is overhyped. The valuation is unsustainable at the moment. That downgrade leading the stock to sell down about 3.7%. And now we are, let's see here. Then it looks like there's a little bit of a China Tesla recall as well. Problems with the door latch and auto steer functions. Okay, I'm going to have to look into that a little bit. Anyway, let's get our job numbers. Job numbers coming out in the next about 10 seconds here. All right, here we go. We're looking for 175. We got, oh my God, 216. Okay, well, there goes. The unemployment rate drops to 3.7. I guess the Fed ain't doing damage over here. Average hourly earnings actually comes in a little strong. Not great for the stock market. 0.4 versus 0.3. Average hourly earnings year over year come in strong at 4.1 versus 3.9. Average weekly hours of all employees come in at 34.3 versus 34.4. So slightly less work. The labor force participation rate comes in at 62.5. So slightly less work, slightly less of a percentage of Americans working, but somehow a beat of change in non-farm payrolls by a chunk here. We've got about 31,000 is the exact number as the beat. We did have a downward revision of 25,000 last month. So we took 25,000 away from last month, and we gave 35,000 to this month. And then those average hourly earnings moving up, probably not exactly the best sign for hoping for rate cuts here. This, I think this is actually going to end up unpricing March almost with certainty now when we start getting some strong numbers like this. Of course, I think it'll more severely wait until, or will more severely rely on the CPI numbers, which are coming out on the 11th. Today is the 5th. But that's a strong jobs report. That's good. My biggest fear is not that inflation's not going to come down, because we've already seen that. My biggest fear is that the Federal Reserve ends up destroying the jobs market. So far, that ain't the truth. That is not what's happening at all. Let's listen in here for a moment.
To just look at some of the raises that are out there, it gets pretty hard to think that it's going to be as tame as many think. And once again, as I said, if you look at Germany's CPI, 3.8 versus 2.3, seems as though the globe is depressing inflation from a media standpoint, but it certainly doesn't seem to be disappearing as fast in the numbers. Becky and the gang, we see interest rates popped up near 420, excuse me, maybe that was 480, 410 in a 10-year, 409, 410, and you see the pre-opening.
He gets so happy when the numbers make yields go up. He gets so happy when the yields go up. Anyway, total non-farm payroll, here it is, 216 in December. Let's go ahead and tag this up here. All right, so what do we got? So we got 216 in December. Unemployment rate was expected to go up to 3.8, stayed at 3.7. Household survey, unchanged, 6.3 million. Measures are higher than a year earlier when the jobless rate was 3.5, which is also pretty dang low. Unemployment rate, adult women 3.3%, 3.5 for adult men, teenagers 11.9, whites 3.5, blacks 5.2, Asians 3.1, Hispanics 5. Long-term unemployed at 1.2, little changed in December. Labor force participation rate decreased 3 basis points. Actually, that's 30. That's a lot. Number of persons employed part-time for economic reasons changed little, but was up 330,000 over the year. These individuals who have are individuals who would have preferred full-time employment. Number of people not in the labor force who wanted a job edged up by 514,000. Those not in the labor force who wanted a job, marginally attached to the labor force, was little changed, but up 306 over a year. So you add in all these other numbers, you certainly have a higher unemployment rate, but it's all right. Not how we do it. Employment continued to trend up in government, healthcare, social assistance, construction. Interesting. While what lost jobs? Warehousing. Transportation and warehousing lost jobs. Payroll employment rose by 2.7 million in 2023. Less than the 4.8 in 2022. Government employment, 52,000 from the government. Healthcare, 38,000. These are late cycle gains. Social assistance, 21,000. Construction, 17,000. Transportation and warehousing declined by 23,000. Let's see here. Employment, leisure, hospitality, little change, 40,000. And this is actually, that's kind of interesting. How did that... Let's look again at that ADP report from yesterday. Yeah, we got a beat on that ADP report. We got 164 versus 125. Kind of, and they saw a rebound in leisure and hospitality as well. Kind of what we're seeing here. Wonder how much of this has to do with, like, you know, snow season resorts and otherwise. But anyway, retail trade, little change, 17,000. Employment, professional, business, services, little change, 13,000. Okay. Average hourly earnings up 0.4%. More than we were looking for, that's for sure. Looking for 0.3%. You want to raise. You want about 3% on an annual basis. But this is closer to 5%. So not great. In December, average hourly earnings of the private sector rose 10 cents or 0.3%. Average work week for all employees on private non-farm payroll edged down by 0.1%. Manufacturing, average work week was little change. Or 0.1 hour rather than percent. Overtime remained. There's nothing really to see in the hours. We do have revisions, we know that. Unemployment rate for the the November jobs report held at 3.7, but what changed for November was we took 25,000 jobs from the last report, gave it to this report, where we had about a 30,000 job beat, 31,000 job beat. All right, looking at the tables, household data, labor force, 167 million. Employed, 160. Wow. What happened to the household data? Look at that. That's a big drop in households right there. Let's do that math here really quick. 161, 183 minus 161, 866, negative 683,000. Wow. 3,000 for household report. So why? Why would... Okay, what the household report, remember, is when they call individuals. So you call individuals and you say, hey, do you have a job? All right, that's the households report. As opposed to calling businesses, hey, how many employees you got? This one is certainly more volatile, but we definitely gave away the 600,000 gains from October to November. Yeah, that's basically exactly what we did. Gave up it's about 584K gains of November. So I wonder, yeah, I guess I don't really know what to make of that. It's just because it's so volatile. Let's see what the suits are saying. If I go into suits here, U.S. employment report. All right, here we go. What do the suits got? Though there's something for bond bulls and bears in the employment report, we think the data is strong enough for the market to price out some of the cuts that have been priced in and leave the Fed on hold until the medium-term economic trends are in store. This report solidifies our view that although the economy is slowing, it's not enough yet for treasuries to rally strongly until later this year. Ooh. Just adding to this point, let's see, dip in participation rate is noteworthy. Yeah, that 0.3% is interesting. It runs against the narrative of a strong jobs market, proving to be a rising tide that lifts everyone. Given that we're in an election year, it's worth noting. JP Morgan says a strong jobs report and large rates reaction makes sense given the move in after the December Fed, with the market focused on rate cuts. Yeah. So my take is March has got to go. Here's what you've got on the Qs. The Qs definitely slid after that report by about another 30 basis points. Listen in here for a moment.
Energy prices came down dramatically. Oil's down 11%. Overall energy down about 6%.
Oh, he's just sort of broadly talking. Okay, fine. What else here? Key factor here is the upside in wages. Yeah, strength in wages will make the Fed hesitant to cut in March. I agree. Well, it's like I said yesterday. Yesterday we were looking at the market still pricing in a 67% chance of a March cut. I don't think it's going to happen in March. As of a little bit ago, before the jobs report, we were pricing in about 54% 64% chance. I think that's going to flip. I think that's going to end up flipping to less than a 50% chance that we get a cut in March. You'd really have to have some soft data. 10-year Treasury sitting at 4.08 right now. Let's see. Sadly for the Fed, labor force participation rate has declined. This is discouraging. Yeah. 10 basis point increase across the curve. All the forecasts about a recession and 2023, what we got was a labor market that's actually as solid as ever. So listen to this guy.
Look at the Fed, and you want me to give them a compliment. All they talk about lately is 3 and 6 month annualized rates based on 1 month inflation. I think that's leading us down the wrong path personally. And 4.1, okay? Let's put that in real context and take all the emotion out of it. Pre-COVID, Jan 2020, it was 3.1. Okay, in February 2020, pre-COVID, 3.6. Since then, the lowest it's been is 3.9 in December of 21. Okay, 4.1 is a bit hot. We pick up the newspapers every day, or you go online, or you get your news from wherever, right? How often do you see, raises 2% or 3%? I don't see any of that. I see raises 18%, 20%, 100%. I think you can call that anecdotal evidence, but I do think that there's a certain amount of inflation and wage inflation and government policy inflation, and I don't see a lot of that going away in a linear fashion, period.
I love his passion. Inflation's not going away. Reals are going up. There are a lot of people who think that you could see the 10-year Treasury go back over 5%. We didn't even really break out 5% yet. But anyway, that's on this belief that, inflation's not going away. I'm not seeing it, but okay. So what else do we have here? So I guess, okay, yeah, I see your question here as far as part-time. Well, they talked about it right here. Number of persons employed for part-time reasons changed little in December. So not much of a change there in the report. The way I look at this is I would love the lowest possible CPI reports and then let people make more money in their jobs. I think that's let's look at real wage growth. I think that would be the best way for people to be able to afford the difference in prices that we've seen while maintaining a strong economy. So let's see here. Let's go. Yeah, so to be clear, I don't think you want to see employment roll over. That's a bad thing. All right, employed full-time median weekly real earnings, wage and salary workers. So this is the breakdown of real wages. And if we change this to a percent change from a year ago, we could see how real wages over here on the right went negative for a while. Zoom in. See this right here? This negative in real wages. We want this to grow for people. So we want to see real wages move up. Right now, with this report, real wages up 4.1% year over year, minus CPI, which year over year sits at about 3.2. Puts you at about 0.9. 0.9 for real wage growth, which is roughly in line over here with Q3. So, and we can see that's clearly lower than what we used to have. We used to have quarterly wage growth of around 1.5% to 2%. Real wage growth. And it really sits negative, well, certainly around times of recession. But, I mean, even in the mid-05s here, you had a low period of time as the Fed was trying to fight inflation. Mid-90s, soft landing. You got some negative real wage growth. Very, 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 very interesting. Very interesting. But yeah, we still have, let's see, what was that chart? Was it 5 days of trading for the year or the first week? Because we only have a 4-day trading week this year. Let's see here. Let's find out. Let me scroll back. There it is. First 5 days. So we still have one more trading day after today. Now, remember, I've warned that this is only based on the past 5 years, so it's not like this goes very far deep into history. But it's pretty blunt. You go negative the first 5 days, you go negative for the year. Pretty wild. Could happen. Got one more trading day after today. All right, let's see how... Oh, look at that. The Qs are recovering after that. How interesting. All right, let's see what we got here. Welcome aboard, Intimacy. I'm watching, let's see here. Okay, Train to Busan, okay. Bozonomics will do all they can to fake the numbers for the election. Yeah, I know that obviously every single report that comes out, the thought is, the numbers are rigged. Maybe. But the Fed is going to react to the numbers as they are. So I'm not convinced that finally a month here where we're showing some more wage inflation is necessarily a bad thing with how low wage inflation has been. I wonder if Nick T can give us like his beautiful charts where he does like the 3 and 6 and 9 month trends. That'd be very nice. Let's see if I can also get a chart myself. Average hourly earnings. Okay. He did tweet about the unemployment rate coming down, but that doesn't help me very much. So I want a chart. Oh, I got it. Yeah, here we go. Okay, let's get rid of COVID, and then I'll pull up a picture here. Yeah. Okay. Yeah, this isn't that big of a deal. This number it's like a roller coaster. I'll show you. Hold on one sec. So, I don't think much should be made of a number that looks like that. Stand by. Look at that. This is what the average hourly earnings look like on a monthly basis. It's a disaster. Because the trend is clearly still here and down, but look at this. It looks like a castle wall. I don't know why I'm thinking of castles, but yeah, it looks like a castle wall that is so up and downy. What's more useful, I think, is the longer term trend here than something that looks like a castle wall. Oh yeah, this is not a big deal at all. Okay. And I'm always looking for things that would make me flip-flop and go, oh my gosh, it's so bad. Come on. Look at it. This right here is your annual wage inflation. Your year-over-year wage inflation. It's literally straight down on your trend. It's, here. That's... So... I think it's funny how the CNBC guy, as soon as yields go up, he gets so excited. It's like, I saw this coming, man. I'm seeing everybody get like 20, 30, 40, 100% wage increases. I'm like, bro, they got to put like it's actually really entertaining. Just let them rant. I think it's hilarious. But whatever. This is the trend. And the trend is straight down. So we're moving in the right direction. This is just, what this is a jobs report that says rate cuts are possibly a little further out, May instead of March. Does that really make a big deal? Not really. Unless we get bad CPI numbers. What it does is this puts more weight on the CPI numbers. It's not so one directional anymore, right? Wow, how weird. Yeah, the rate cut estimates right now are about 64%. I thought they would have slid down a little bit more. It's possible those still need a little bit of updating. They might just still be a little bit behind. Sometimes those take about 25 minutes or so to update the projections. So because I expect that to go under 50% today, that we have more of a 50% chance of holding. We'll see. All right, what do we got here?
Overall, along with healthcare, along with tech, along with other things you talk about, it's a reflection of different kinds of supply and demand imbalances. Remember, one of the questions that is driving inflation is, well, how much fiscal stimulus is there put into the system? That gets reflected in the government number. So I would be a little cautious about saying, private sector number is where we should put most of our weight. The government is an important part of the economy, and it's a reflection of fiscal policy, and it's a reflection of a different kind of supply and demand. So I tend to look at both, but I would be a little cautious in saying, all weakness or more weakness in one versus other.
Yeah, I'm only saying that because local government just pretty much got up to the level it was at before the pandemic, so maybe some of that eases off.
John here says a second wave of inflation is imminent. I know that's a very common thesis, and it's a popular argument on a day like today, but where is it? Like, please, I beg to be shown where the inflation is. Where is it? And then every time I ask, I hear nothing. I'll tell you where it is. You have limited, you still have problems, and AI chips. The NVIDIA H100s, way more expensive than they should be. You have some in aviation and some in ski resorts. That's it. Restaurants, RVs, cars, auto parts, AutoZone, computers, tutors, hooters, computers. It's all negative. Or flat or low. Restaurants. I don't see it. And then you look at housing as well. Housing's another one where you're seeing the rate of inflation come down. I like the there's like the Zillow rent tracker, which is kind of cool. It gives you a little bit of an indication of what's happening in rents across the U.S. Look at this. Phoenix, downtrend. L.A., downtrend. Dallas, downtrend. Orlando, downtrend. Miami, downtrend. Chicago's actually moving up. San Diego, downtrend. Houston, downtrend. New York, downtrend. Atlanta, downtrend. Rents are going down. You're shaving off the hump so you get what looks like more flatness. Food inflation has been negative as well, coming down. That's not to say, average grocery bill 40% more than was a year over year. I don't know if that's true. Let me see. We'll look. Kenji says inflation is everywhere. Kevin has super low IQ. I actually think you have a super low IQ to forget, and that everybody has this problem, to forget that I'm not saying there hasn't been inflation. I'm saying the rate of inflation is coming down. Like, I don't know. Why do I have to say this every time? You know why I have to say this every time? Because American schools don't teach this stuff. You don't learn in school that prices can go from $100 to $150 and then go to $150 the next year, and inflation is zero. Yes, everything is now 50% more expensive. Everything's 50% more expensive. But inflation now is zero. Because the rate has stopped. The growth has stopped. Let's see here. So I'm trying to find, here is there's like Lane Report. I've never heard of this. And 24/7 Wall Street, and then you have this is a very interesting disparity in the reporting here. So look at this. NerdWallet says the cost of groceries are up 4.3% from a year ago. And then you have 24/7 Wall Street, who says the average grocery bill, or the grocery bill for an average family of 4, was $325 per month. In 2023, that's gone up $100 per month, around a 71% increase in monthly groceries in just 1 year. So one website says 71%, another says 4.3%. So pick which side you're on, and then use whichever statistic you want. That's crazy. That's crazy. So, I think what's so worth remembering here is multivariate core. I love looking at this because it includes groceries. It includes the various different forms of inflation that we face. And so when we look at, you can even look at the decomps here. When we look at goods, we could see goods are essentially at 0. You could see services x housing is substantially low over here at 0.17%. Housing at 0.46, trending down, but still elevated. Still elevated levels of growth there. And then you have your multivariate core trend down at 0.52, which is a collection of everything. Substantial move down. Well, so that's very interesting. And then let's look at the bond market, because consumers expect inflation to trend down based on the U of M surveys we've been getting. The bond market, after this jobs report, is pricing in another about 4 basis points of inflation from yesterday. I'll pull this up in a moment. 5-year forward. Let's get the forward. Let's go get the 5-year break even as well. So we'll have the 5-year break even and the 5-year forward. Yeah, both of them are seeing a little bit of a tick up. Okay. Which that would make sense based on the jobs data. Let's look at the inflation expectation on a chart though and compare it to the rest of the year. All right. So what you have here is this is the 5-year forward inflation metric. So the 5-year forward inflation metric, it ticked up from about 2.14 to about 2.24. So you've got about 10 basis points of a move up in the 5-year forward. And if we try to compare that, let's go with a red color here to make it a little more visible. There we go. Let's get a straight line here. Ish. That's roughly straight. Let's check it. Yeah, that's roughly straight. Okay, so that puts us about here. So for a month, for sort of a month-over-month basis, very much in line with what we've seen pre-2023. And obviously exceptionally, low compared to the inflation expectations we had in 2023. So that's the 5-year forward. And then if you do a similar analysis over at the 5-year break even, and let's get a relatively straight line here again. There we go. Look at that. So you've certainly come up from your depressed levels of inflation expectations in December. You've certainly moved on these for inflation expectations, but still very, very, very low. Okay, here we go. Looks like the numbers are now updating. Finally, okay, here we go. We're now sitting at, almost a coin toss. That's what I thought. Almost a coin toss for a March rate cut. I don't think it's going to happen with how strong this number is. these numbers are. They'll push back here, but that's a combined 56.4% chance right now of a cut in March. So the market's still leaving enough in there to say, yeah, I still think could come in March. These numbers muddy the waters on when the Fed starts to ease. Dudley here, someone basically says May is now more likely. Market, let's see here. What do we got? Bond investors got what they're looking for today, a stronger than forecast report, including a headline number and drop in the unemployment rate. Investors are not willing to fade the downtick and instead are sticking with the bearish bias. Let's see if that's true. No, we're only up 6 basis points. We had shot up as much as 11 basis points. So we're up about 6 right now. That's not that big of a deal. Market's actually already kind of trimming some of those, maybe buying those bonds at the higher yield. Let's listen in here for a moment.
Interesting. Government, 52,000. That was a big delta. Healthcare has just been strong, 38,000. But we have construction that's up a little bit. And
we already read all these numbers. Dudley adds the economy is doing pretty well. GDP growth probably exceeded 4% in the fourth quarter. That's a big drop down from 4.9 in the third, but still above the long-term trend. This reinforces the Fed won't be in a rush to cut. I agree. Hard not to imagine whiteboard scribbling at the Fed this morning. Oh, they probably did that yesterday. They get the stuff before so they can trade on it. I mean, so they can review it. Payroll's up, earnings up, unemployment steady. How do you spell soft landing? Lols. As the dust settles, swaps indicate the odds for a March cut are holding around 50%, with around 5 quarter basis point cuts seen for 2024. Combination of the surprise in hiring and earnings will drive up medium forecasts for U.S. Treasuries. Yeah, not a lot of people were expecting this. In fact, let me see if I can get the survey on the wage growth, because the wage growth number was definitely a surprise. Yeah. Wow, very few people were expecting this number. Okay, I'll show that on screen in just a moment, just so you can see how much of a shock it was. Okay, here you go. Take a look at this. This chart shows you the shock factor. Again, I personally like this kind of report. I want to see, as we're expecting, very low inflation, but let people make more money. Let people make more money, let people have jobs. Otherwise, you go into recession, which is way worse. Like, complaining about a strong jobs report is twisted. It's a good thing. Yes, does it potentially slow the Fed's desire to cut? Yeah, because they're not burning the labor side as much as maybe they thought in the last meeting. But look at that. You have a very, very clear median trend here of between 0.25 to 0.35 for what we were looking at in terms of where wage growth would come in. Very, very few estimates. I mean, out of the 67 estimates, we had, let's see here, like six estimates at about 0.4. And that was the high estimate too. Let me see if I can count that. Yes, I can. Citigroup, JP Morgan, Nomura, UBS, they were all at 4. Yep, it's exactly 6. So 6 estimates at 0.4. And so sure enough, all of the other economists were wrong. Surprising. That's a good chart to keep in mind, though. Okay. But again, this is a good thing. The last thing you want is deflation and a recession. And, too many people cheering for both of those. Okay, good. So let's get a little bit more on suit talk. So we have more than half of the increase in payrolls came from education, healthcare, and leisure and hospitality. Yes. Labor data is generally run hot with few caveats. Downward revision of 71,000 of the prior 2 months of data. Okay, adding together the prior two. Household employment dropped by 683,000. That's the number we looked at right away. We're like, but we also kind of scratched our heads and wondered, how does payrolls come up and households come down? That's weird. It's like the dispersion of people with jobs is lower, basically. So more people have more jobs. Well, no, less people have more jobs. Yeah, that's the way to put it. That's bizarre to kind of wrap your head around that. Is that right? Like, if there are 20 people in a room and everybody has 2 jobs, then you have 40 jobs in the payrolls data, and you have 20 in the households data. If one person leaves the jobs world, then 19 have jobs. But then say one person picks up a third job, you still have 40 jobs from payroll, but you have one less person who's actually working. So that's why I mean, like, the dispersion got shifted here. Households is also one of those numbers that just very, very volatile, but very interesting. Do they have? Oh yeah, they got a Brainerd coming up. Is she gonna be the VP there or vice chair? That's it. Yeah. She's the vice chair of the Fed. See, they took it away. But yeah, it looks like she might be coming to speak on CNBC, so we'll have to watch that. Let's see here. Another spread between the two. Household figure does tend to be more volatile. Hey, that's what I just said. Are they just copying me? That's okay. I still love everyone. So for all the the 2024 recession, this definitely weakens those sorts of thoughts. And Nick T is tweeting about latest revisions to the payroll data show the economy added just 44,000 private sector jobs in October. What? Private sector payroll growth 3-month average. How is he getting this? Hold on a sec. Nick T, what are you saying? So, change in private payrolls. Well, private payrolls, not non-farm payrolls, came in at 164. The November report was revised to 136. The latest revisions to payroll data show the U.S. economy added just 44,000 private sector jobs in October. The 3-month average for private sector hiring was 115,000 in December, matching the lowest level since the economy opened up. Okay, so let me show Nick T here. All right. Nick T. Here we go. This is the chart Nick T showing, and it shows you that this sort of like slowing down of the slowing down trend. I actually think it's fantastic because it's settling at a place that means no recession. So that is good. Somebody says strong labor market due to wasteful government jobs. Oh, well, let's be clear. The government's definitely running up the stimulus check bill right now. It's just not going to people. It's going to companies. So that is not untrue.
Name my darn dog after my dog cufflinks. These are my NVIDIA. This is NVIDIA, okay? I put we have the camera. We don't have handheld or anything here. But this is my NVIDIA cufflinks, and I wore them. This is my dog named NVIDIA.
Okay, that is kind of cool.
Staunch the decline. And sometimes you have to throw a maiden in a volcano. Here's so there to say.
Max says, what do you think about this? Looking at the spread between bond yields and the Fed funds rate, you see no cuts priced in for the 3 and 6 month spread. only 50 basis points for the 1 year. Yeah, I don't really know. You know how the bond market gets traded. It's not how I like to look at the expectations for cuts. The sort of aggregate futures pricing of expectations for March right now leave us at 57.3% chance of the first cut in March, which is definitely down from like the 75% we had a week ago. It's down from the 68% that we saw a few days ago. But the way the bond market prices in the short term, is pretty wild. But it's entertaining to see. I mean, what was our swing on yields today? It's a good question. I don't know the answer. Yeah, up 7 basis points right now, 4.06. What's really interesting about that is I wonder what it's going to do for housing, because there were a lot of people who had this impression that housing was going to explode in the spring. I don't think so. I'm of the mindset that housing is relatively stable and that there are actually a lot more choices. Right now, it's kind of like inventory is ridiculously low right now. It's been low, but it's been workable. For a very long time, it's been workable. But it's just recently plummeted to where it's like, okay, well, you take ridiculously low and then you add in, Christmas holiday. Maybe that's not a horrible surprise. And yes, that's true. But there's very little right now. And so mortgage rates will be very interesting because mortgage rates started to trend down. Let's see here. Look at mortgage rates, for example. Here are mortgage rates. If we go to the 740 credit score, we dropped to about 7.3. So we came off of the 8s. See, look at that. Right here in October, when the treasuries, the 10-year treasury was running up to about 5% with the Bill Ackman short going on. You've got 8.4-ish on the mortgage rates. And we've dropped all the way down to about 7.3. As the 10-year moves up, you actually end up seeing mortgage rates move up as well. So some of that direct fall is not necessarily going to encourage as much buying maybe in the spring. Who knows? Didn't Ackman bet on cuts by March? I don't actually remember exactly. I do know that he was screaming at the top of his lungs that the 10-year treasury will go, quote, well past 5%. And then as soon as it got to 4.99, he covered his short and started buying bonds, going, you know what, these are too good of a deal. You should buy the crap out of bonds. And then yields fell. And it was just like so perfect. And it's so manipulated by him. Like, he's really powerful when it comes to the bond market. But to me, it just comes across as the same shystering that he did during COVID. And it's hilarious. I don't know. So, all right. Let's see what else is being said. All right. Some straight to the point reaction here. Give me a solid labor report with disinflation all day long. That's what I'm saying. A strong employed consumer trumps all. If your recession call is predicated on job losses, this report isn't for you. 100% agree. Now, again, the wage inflation number is something that has people going, but, is this going to be a wage price spiral? It's a strong wage number, but it is a declining wage number, as we saw in the chart, and it's also a volatile number. So, the trend is still straight down, basically, on wages. But yes, love this for avoiding a recession. Canada's labor market missed expectations for December jobs. Let's see. I'm going to Canada soon. It's for work. It's not a vacation. Canada was looking for 15,000 job gains. They got 100. What? Yeah, 100. No way. Yeah. Canada was looking for 15,000 job gains. They got 100. 100 jobs. Not 100,000. 100. Like literally 100. Wow. That is a weird number. Huh. Okay. Unemployment rate moved down to 5.8 on that. Labor force participation rate moved down. Average hourly wage year over year came in higher than expected. Similar to what we saw in the United States. Huh. Very interesting. Ha! Yeah, Bax, you're right. Nick T just told somebody to unfollow him. I see that here. Somebody's like, why we can't believe the headlines or media rhetoric? The numbers are printed to meet political agendas. They come back, let's see, to keep fear at bay. Then they come back and quietly revise the numbers down. Things are not good. Nick T replies, that's not how revisions work. Please unfollow me. There you go. I just replied to Nick T and like, yo, when interview? Hit him up. Tell him, yes, do interview with Kevin. All right. What do we got here?
Booking platform highlight the impact. Spot container rates
Now.
for shipping goods from Asia to Northern Europe now have soared 173% since mid-December. Meantime, the IMF says Suez traffic is down 28% in the last 10 days. You got Maersk, Jim, said earlier, going back to diversions. This is starting to show up. IKEA, A&F, talking about delays.
Look, I mean, I thought that, Mike Worth's view is he's gospel, and it's obvious that this market's in incredible turmoil. We had those EOG comments. I want to go back to them for a second. Good company saying there's going to be a decline in growth. Remember, it's not a decline in growth in the U.S. I don't believe that, but I think that EOG is too conservative. But through all this, why isn't oil at 80? I mean, the market seems to be taking this stuff in stride for the moment. Right. It's really interesting. Like Mike Worth is basically talking about almost everything being a suspect, and yet they're still producing.
As far as container rates, Journal, a great piece today about how some of the shippers, their stocks are doing well because of these surcharges.
Right.
Oh, yeah.
But you got so much capacity coming online this year, 11% of the current fleet. It's going to offset some of that.
Well, that's why I was going back and forth yesterday with Herb Jordan Hansen for Nordic American Tanker. That should be the big winner. The stock's at 4. It's been at 4. I mean, it's not doing anything. And I was saying, look, Herb Jordan, I know that you're supposed to be the way to play this, but it's not moving. He's obviously just saying, just wait. He talks as his book. I don't have a book. But again, no one's making any money off this stuff. It's just, we're just watching the geopolitical tension. Typically, geopolitical tension should mean something. But this is not 1973. It's 2024.
Right. We do have Blinken going back to the Middle East, his 4th trip there since the October 7th attacks. Then you have sort of the larger, almost rhetorical battle against American companies, which is what McDonald's talked about yesterday.
Right, and I think we have to remember that as franchises, I'll tell you, it's so difficult. My Chapel Trust owns Starbucks, and Starbucks doesn't have any stores in Israel, but is viewed as, there was a TikTok post that basically implied that you're buying. I don't even want to dignify what the TikTok post. You're buying from someone who's the strident, militant Palestinian faction doesn't want to buy from, and it was not true. And so therefore, I don't want to dignify it. But what does matter is that some of the stores had bad numbers, and Now people will hear what I just said and they'll say, "Oh my God, that's all."
All right, we're gonna pull off the TikTok speculation here from Jimbo. Okay, so I do have research on container rates, which I want to look at. Hong Kong to LA. All right, so let's get some numbers here. We're gonna write these down too. Hong Kong to LA. Thursday, we got our spot rates late yesterday. No, where's it? Oh, here we go. Okay, this is what we want. Container liner rates jumped 61% over the past 2 weeks. Okay, so container rates 61% over the last 2 weeks to 2670 per 40 foot. That's as of Jan 4. So yeah, as of yesterday. And that's according to the World Container Index. Let's see here, rates for Shanghai to Rotterdam are up about 115%. Globally, they're 99% higher. That's double, basically, since bottoming in October. Rates above break-even levels for many carriers, which may limit losses in Q1. Strength is not structural. We expect levels to move lower once hostilities in the region subside, supply and demand imbalances widen. Yeah. China container rates up 40%. The Shanghai Containerized Freight Index jumped 40%. Fifth week of climbing. Let's see here. Container volumes poised for more growth on easy comps. What's this? Container volume up 9.3% year over year. Third consecutive month of gains. Total volume growth may accelerate to 3.7% in 2024, based on Clarkson's forecasts. Okay. So volumes up are positive for growing economy, of course. Rates up are not great for inflation. The question, though, is can those higher freight rates be passed on to the consumers? Less likely. It's going to hit companies in the margin. Yeah. Rob here is asking, what do you think container prices could do for inflation earnings? It hits companies in the margin. So companies that are shipping, especially from China to Europe, it's a problem. So not great. The longer this lasts, the more inflationary it is. And you certainly have a problem with the Red Sea. And it's very frustrating that me personally, I was very optimistic about U.S. warships entering the Red Sea to provide stability and escorting container ships to prevent inflation. I know that's an expensive way to prevent inflation, but it provides stability. It shows American strength and power. The fact that somehow we failed, I don't think it's the men and women working in the military. There was some kind of other, handcuff put on our military over there. Sad. So, yeah, the Red Sea, absolutely problem. Yeah. Okay, so that's also led oil prices to rise. Let's take a quick peek at oil prices. How are we doing here? But still not over 80. We briefly broke over 80 when some of the Red Sea drama was starting. But slowing demand in China is really putting a lid on oil prices here. So you go to the 3-month. Yeah, you're off the lows of about 73, but you're at 78, 71 for Brent. It's not that high. Those are your March futures. December figures wrap up another solid year for the labor market. Yep, the data seems like Goldilocks to me. I don't necessarily disagree with that. The numbers are pretty good. Treasury yields settling some 5 bips higher. Yeah, that actually isn't that bad. Let me see here. Yeah, 6 basis points on the 10 right now. The Fed does want this, right? They want this kind of employment growth. So I think it's very difficult to argue that this is so bad. I think again, it's going to put a lot more weight on CPI. CPI on the 11th. Let's see the projections here. 11th, we're looking at core of 3.2% and on a year over year. Oh, sorry, that's non-core year over year 3.2, core year over year 3.8, and then month over month we're looking at 0.2 for both core and non-core. Let's take a peek at. Let's do FedNow real GDP. That's been pretty accurate. I don't think they would have updated it with the jobs report just yet. Yeah, this goes through. Yeah, look at this. This goes through Jan 3, and the next report is going to be, or is expected for Jan 9th. And the GDP report right now is estimated around 2.5%. Wow. All right, we got the opening bell here in about 3 minutes, so we'll be covering that. Very curious to see how stocks are moving. In fact, let's go jump into. Let's take a peek here to see how some of the sticks are moving. What kind of behavior have we here? So this is Zim. Zim's actually down 1% today. It had a crazy rally yesterday of 11%. Totally makes sense after the U.S. failure. You know, as the U.S. was sending warships, made sense to short. As the U.S. started failing, made sense to go long. It's such a failure by the U.S. It's crazy. Anyway, sitting at a fib over here. Classic fib retrace. You've got the NASDAQ. That's actually recovered completely since the jobs report. Again, like, I want to be exceptionally clear. You get a bad jobs report, people can't buy stuff at companies. Bad jobs report equals bad earnings. Good jobs report equals better earnings. Does that mean more inflation? Not necessarily. Unless companies are willing to do a lot fewer volumes, and most companies aren't. They need volume growth. So, okay, they're previewing interviews. What do we got? What else do we have? So let's go pre-market here. Peloton up 5.8%. Yesterday they were up 14% on that TikTok news. Costco back to about 655. Nvidia 484, sitting up about 85 bips. About 1 minute to go to the bell. Intel slightly green now. Palantir, Enphase in the pre-market down, both about 3%. Boy, Enphase 3% yesterday, 3% today in the pre-market. Affirm down another 2%. But as the market unprices rate cuts, of course the interest rate sensitives are going to get hit. And then here is Tesla down about 35 basis points. All right, let's listen to the bell.
But
If you're on GLPs.
yeah, it's like whiskey, water. Well,
Remember years ago when the Fortune cover was "Are we in a bourbon bubble"?
Oh my!
You're saying it's the opposite of that.
Yeah, and there are companies, there are actual banks that got caught with barrel futures. They're like too long barrels. But there is, I think people are under. Plus, the Chinese are not buying the very expensive.
Oh yes.
forget it. I mean, don't.
Well, you and I talked the other day about the potential impact of cannabis on alcohol
Cannabis
sales.
is killing it.
And now the rumors this week of all this DEA rescheduling. Right?
Yeah, no, I mean, now, of course, Constellation Brands owns Big Check and Canopy. Do not buy Canopy. There's nothing there. I think there's nothing there. I mean, there's Tilray, but I don't want to recommend anything having to do with cannabis other than to say that cannabis is really hurting the Browns and the Cleveland. Really hurting.
We'll watch that. Let's get the opening bell here in the CNBC Real-Time Exchange. Speaking of beer, at the big board today, it's the professional bull riders and Anheuser celebrating the partnership of the sports competition at MSG this weekend. At the NASDAQ, it's XBP Europe, a payments technology company celebrating recent listing.
Yeah. So look at that. That's, what, 70-ish% red? So let's see how things move here at the open. Got some volatility here on Tesla, volatility on Enphase. Nobody knows which way to go. Down almost a couple percent there on Zim. Q's moving up. Palantir trying to move up after the Jeffries downgrade. S&P 500. Let's look at the SPY so we can see it compared to pre-market. SPX won't show pre-market. There you go. Slightly positive on the Qs and the SPY. Affirm down just around 1%, same as Coinbase. How'd they do yesterday? Coinbase. Yeah, slowing a little bit. Slowing their decline. Trade Desk, 68. Apple, slightly positive. Nvidia's up 1%. Boy, they've been bobbing around the 480s forever. It's like no news. It's like become a safe haven. You just sit there. Does nothing. Peloton now up 5.5. Redfin, SunPower, SoFi, these guys all down 2.5-ish. How's SunPower moving? SunPower, yeah, there's a nice little drop on SunPower. Ooh, Tesla dropping again a little bit. Tesla had a bad few days here ever since those delivery numbers came out. It's basically been straight down. You've lost about 30 points from the high of just a few days ago. At the same time, same time as Tesla's dropping here, actually at the NASDAQ still pushing green. All right, let's listen in here, and then we'll grab some more research thoughts.
Go straight down. I mean, Apple every day. I mean, Loop Capital's a little late to the game of the negativity, given the fact that the Morgan Stanley call is a very powerful call on the App Store, which everyone has dumped on the App Store, and it versus the Foxconn, which is a negative story. So, look, accept the fact that stocks don't go straight down. Yeah. That's all I'm saying.
There's some impressive action in some semis. AMD is the second biggest S&P-er.
I pushed
Nvidia.
AMD pretty hard last night because I think AMD really surprised people with the forecast. And AMD, remember I did this PC refresh thing with the Microsoft button?
Yes.
It was so clear that everyone had me on mute. They're like, oh, mute him. He says PC refresh. But I think there will be a PC refresh.
We'll watch for some of the impact on some of those names.
How about Costco?
Yeah, I was going to say Costco, December comps, not just the comp, Jim, but discretionary non-food with a nice 4%.
Wasn't that something? Rich Galanti, who's the CFO, who's just remarkable, has a little quote about gold today. I bought my gold. I bought my gold from Costco.
At Costco.
I don't think they actually make a lot of margin on gold, by the way. I think their margin on gold's maybe 1%. So, think about that for a moment. If you sell a $2,000 1 ounce chunk of gold, you're making $20, and it's expensive to ship. It's dangerous to store. It's prone to theft. It's a horrible thing to sell in a grocery store, in my opinion. But whatever. People are very excited about Costco selling gold. And that's fine. That's fine. Costco did release their December sales numbers. Their December sales numbers came in with an increase of 9.9% to a year ago. Most important part for Costco, though, is not margin, memberships. Memberships. 17 weeks ending December 31st, company had a net sales increase of about 5.9%. Net sales for 17 weeks were impacted by a move in the fiscal calendar. That's fine. This year, that's how they got that beat around Black Friday. That was so delicious. They didn't give any membership info. Of course not. Or margin. That's all right. All right. What else? I'm looking for some reaction from researchers, but so far nobody's actually posted their reaction yet. So instead, we'll look to see if our boy Nick T's got anything else for us. Nick T, yeah, he did post index of weekly payrolls for the private sector, which combines hiring, wages, and hours. Didn't change between November and December. The index was up 5.4%. Yeah, and you could, I'll pull this up here. You could see the trend of decline. So there we go. Right here. I mean, the trend is clear in jobs. Okay. Let's see bonds now that the market is open. Bonds with the market open. We are sitting at bond market up 5.9 basis points. Gold 20.51. Bitcoin 43.6. Obviously, the big thing everybody's looking for right now is the ETF approval or not. So Bitcoin roughly flat on the week. Ethereum down about 6%. Solana down about 8% on the week. XRP down 10.7 on the week. Cardano down 13% on the week. 14% on Polkadot. Polygon down 16.5. I think what you're seeing is the crypto market move down with the equities market, where you're seeing a little bit of a give back. But then again, look at the Qs. I mean, the Qs are just taking off. Enphase actually recovering. It's only down about 68 basis points right now. Zim goes positive to about 3%. It's great if you're long Zim. The only reason to be short Zim is if you have confidence that Biden can lead American-led stability in the Red Sea. That would be for going short Zim. So in other words, I think a lot of people are going to go long. I can't. I don't want to get political. So, yeah, just Piton up about 4% today. Bill up 1%. Got the one on Costco, Nvidia, Home Depot, 73 bips. How have they been? Even Disney's up. Let's look at Home Depot sort of broadly, zooming out a little bit. Not bad, actually. Let's go to the week chart. Yeah, you've got this slow trend up that they've been on. Little volatile there. Let's look at lows. Lows, same trend basically. Restoration Hardware we know is pretty low. They're closer to a bottom here. What's another one? How's Wayfair doing? Boy, it's been a while since I looked at Wayfair. Maybe we'll do an analysis in the course member live stream on Wayfair. Let's see here. Fear and Greed Index, 73. 2 points from extreme greed. That's not great. Key determinant in gold's price will be the Federal Reserve's approach to balance sheet reduction. They did just give us a hint on that, right? They gave us a hint that they were looking at starting to talk about slowing the balance sheet reduction. And balance sheet's not going to go back to where it was. Yes, that's correct. Somebody here is asking the question. Kevin says real wages are rising, but he also says companies can't pass on their costs to customers. Yes, that is true. Both of those things can be true. So you have to keep in mind, companies want to grow. So let's say you sell 100 widgets in 21, and then you're like at 90 widgets for 22, and you're like, oh. And then you're at like 80 widgets for 2023. It's like, crap. You know, you're selling less widgets. And maybe before COVID, you were selling 50. So you're like, okay, we're down from 2021, but we're way up from pre-COVID. That's the case for a lot of businesses. Now the question is, the company wants to get into selling more widgets. So what do? Do you raise prices to sell more widgets when volumes are declining? No, of course not. Because you can't. Because then you'll sell even fewer widgets. So instead, you reduce prices. And as you reduce prices and people make more money, you can get volume growth. So you would actually, in my opinion, see reduced prices and higher unit volumes as people are able to pay more because they're hopefully finally starting to earn more. There was a very long period of time there where, you know, like a good year or whatever, where wage growth was negative. That sucks. So, somebody says, you'd mentioned you'd flip-flop if a soft landing fails. So, in order to really identify a failing soft landing, the biggest catalyst, and I've been talking about it, would be jobs. What else? That's probably the biggest one. Because, yeah, you'll have volatility in earnings, but that's not a catalyst in itself. That doesn't cause a soft landing to fail. You could say GDP, but I'm not using GDP as much of a reliant tool right now, mostly because the government is printing so much money for their own purposes in stimulating manufacturers that I don't actually think betting on GDP is the right way to go. I think betting on jobs is better. Yeah. All right. Let's see what else here. Somebody here, Andrew says, sell big caps to buy the dip on smaller caps. Yeah, the biggest issue that I've had with the smaller caps is the interest burden that they face. It's a very, very expensive time for smaller businesses. And I'm not a big fan of being heavy what I call the Magnificent Six, mostly because Tesla has not been very magnificent. So I'm more, well, I mean, I do like Nvidia and Apple as some part of the portfolio, but I have much more of a focus on like your ASML, your TSM, your Enphase, your AMD, Ubiquiti, you know, considered the home supply stocks, the Home Depots, the Lowe's is considered, but I haven't exposed myself to those. Intel, these are much more interesting to me because I think I see these companies as very, very resilient to the pains of small business pains, while also having the opportunity for growth beyond, you know, just the Magnificent Six, which there'll probably be a limit to how much they can grow this year after the growth they had last year. Okay, let's see what else was mentioned here. Okay, nothing else there on jobs. That's fine. Let's get into Apple's 2024 slump puts most valuable stock title at risk. Okay, whatever. Let's see. Oh, there's really nothing else super high news right now. Let's see what if they've got any mentions over here.
On a morning where people, the thinking was, oh, we got to rethink rates. Names like Pulte are up 1% or better.
Look, I think that you posted a very good point, on X.
From Fitch?
Yes.
Yeah.
It's not a hot number, which means that housing will continue to be good. They're not building as many homes as they did before. Their raw costs are down. They're making a lot of money. Toll Brothers bought, I had like Toll Best here. Toll Brothers bought a huge amount of stock. I mean, this is not your grandfather's home builders where they'd be putting them up like mad and they have no buyers, or even the 2008 period when I literally went out to the Imperial Valley to see if I shouldn't just buy land and become a...
Yeah, I'll clarify this. Somebody here says, you were the one saying jobs are a bad indicator. No. I said jobs are a lagging indicator. Very, 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 very big difference. Jobs are a critical indicator. They are just lagging. So what that means is you have to try to find leading jobs data. Well, leading jobs data would be what you're hearing in earnings calls at companies. Like, I don't think you can do fundamental analysis without studying earnings calls every day. It sounds like a broken record talking about it, but it's very, very, very important to get in on those earnings calls and understand what the prospects are for stabilizing versus hiring versus firing. Most companies right now are talking about how they can clean up their margin and become more efficient businesses. So that actually is a weakening leading indicator, as are the reports that you get from some of the payroll processors. Like, weak seasonal hiring. That's usually a bad leading indicator, right? Those are leading indicators that are problematic. That's why, as much as today's jobs report is great, you still want to be careful, because you could definitely poopy-doopy the labor market really, really quickly. So, anyway, all right. Let's play this button here and then get to the course member life. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Remember, folks, the risk of the Fed overdoing it is the greatest risk right now, and it still is. And unfortunately, a jobs report like what we got this morning might send a signal to the Fed of like, oh yeah, don't cut soon, don't cut soon. Some of the leading indicators in the jobs market are still showing weakness, and so they do make me nervous. Again, I want the jobs market to be strong, and so as that jobs report is today, it's like great, good. You don't want a big miss, because then you go recession. But the real risk is still there that the Fed will overdo it. Mostly because I don't think inflation's a problem anymore. Prices went up. Things are definitely more expensive. But the rate of inflation has cooled so substantially, I think that job is almost done. All right. Thanks so much for being here. I got to get this another cup of coffee going. 10-year Treasury yield up 5.3. It's kind of actually roughly how much it was right before the jobs report. So it's not that big of a deal. All right, folks. We'll see you. Thanks for being here. Bye.